Think Realty Nation, it's Abhi Golhar, the host of the Think Realty podcast. Great show and a great lineup for you all today. We're talking about some things that are going in the market that you need to know about. So that's coming up. And then my friend Tucker from TTM Finance will be joining us, followed by insurance tips. Everybody needs a good insurance carrier, and you need to learn a little bit about insurance in order to get going in this business. Just like having a good team is important, you want to make sure that you can mitigate some of these risks with the right type of insurance. So a quick little tip or two about insurance, and last but not least, a wealth building tip that you can use from yours truly that is actionable today so you can start buying property. All right, that's the show. Let's go ahead and get started. This podcast is brought to you by Renters Warehouse, one of the largest, fastest growing, and highest reviewed property management companies in America. Check them out, renterswarehouse.com. All right, so NAR pending home sales index rose 3.8% from February to March of this year, breaking a 15-month streak of straight drops. And this is for the first time in 15 months. That's right, despite a steadier course. This is coming directly from NAR, by the way. And this is economist Lawrence Young, who said the change comes as a result of falling mortgage rates and an uptick in inventory nationwide. Something to be concerned about or not, or is this kind of a rebalancing act? Quote, we're seeing a positive sentiment from consumers about home buying as mortgage applications have steadily increased and mortgage rates are extremely favorable, which is always a good thing for homeowners. Despite some affordability issues in the West, the numbers indicate there's a reason for optimism. This is what economist Lawrence Young from NAR is saying. And inventory has increased too, but these are also really good conditions for the region. And while home sales are slated to improve in the months to come, the annual numbers may be slow to catch up. And that's according to Danielle Hale, who's the chief economist at Realtor.com. So again, are we crashing? No, we're not crashing. Are we seeing a rebalancing? Absolutely. Would I be fearful? Absolutely not. We'll tell you when to be fearful. And then, quite frankly, you'll just want to go and dominate by buying as much of America as you can. Isn't that the point? Tucker, are you with me?
I'm here.
Awesome, man. Hey, good to have you. I'm excited for this conversation because you have such a depth of knowledge in the real estate space. You started back in 2002, and now you have, I think, one of the longest running podcasts as well, called the Real Deals podcast. You mentioned it was one of, I think, the original three, or one of the first three real estate investing podcasts on iTunes when it first came out. So congratulations on all of your success so far. But you can tell the story about you better than I can. So tell us a little bit about who you are and what you do.
For sure. As you mentioned, the podcast, that's kind of a big thing. We started that in 2013, which back then, Bigger Pockets had just started their podcast. And I think I was one of their first 10 guests because they were scrambling to get guests back then. People weren't lining up to be guests on the Bigger Pocket podcast. So Brandon Turner actually reached out to me. He's like, we need a guest. And I was like, I've never done a podcast before, but I'll give it a try. And so it worked out, and that helped springboard then the launch of my own show in 2013. But my career in real estate goes back about 10, 11 years before that, where I came out of college. I got into the mortgage game, started as a loan officer, eventually opened my own mortgage company. That business changed dramatically in August of 2007. When basically all of the lenders out there froze their pipelines, the mortgage program, so to speak, changed completely, and the world started to implode on the real estate side. And so I limped that company along for another 3 years. And then after that, I said, you know what? I'm sick of the audits. I'm sick of just really grinding out. It was not a fun way to make a living at that point. But there was also a big opportunity that presented itself. I had at that time done what they call house hacking. You live in a house, you fix it up, you eventually sell it, and you make some tax-free money. I'd done that a few times. I'd done a few house flips. I'd bought a number of rental properties that I've accumulated or had accumulated at that point. And so towards the middle of 2008, after I'd just been punched in the mouth a number of times from the mortgage side of the business, I said, you know what? Let's look at the opportunity of this bomb hole. Yeah. And from there, I pivoted and I started TTM Development Company. And that, in its infancy, started out as basically buying REO properties because there was a big influx of REOs starting to hit the MLS at that point.
Yep.
There was nobody buying them in Portland.
Yep. So
And
hold
so
on.
we were able to.
So hold on for me. REO, for those of our viewers and those of our listeners that don't know, back then that was a really big business, and so was property preservation. But can you tell me a little bit about REO, more specifically, and what your thoughts are and how you got into that space?
For sure. I think I bought an ebook that was titled "Mold is Gold," and so that was kind of my beacon as far as giving me a guide to REO investing. So I wanted to find stuff that, number one, had some type of water damage that eventually turned into mold, which they said, banks would take a bigger discount for properties that had mold, which was true. And it wasn't difficult to find properties that had a lot of issues like that, because a lot of the previous owners left it in not only disrepair, but left disgruntled. So there was a lot of stuff that came on market that was really beat up, had a lot of issues. And so what I did is, it was a pretty simple form of real estate investing at that point. But essentially what I did is I worked with a couple of agents, and we just put in offers on stuff that looked like it had a lot of problems, mold, ideally if we could find it, or some type of water damage, or just really beat up. And then the second thing we'd look for is days on market, right? So if something sat on the market for 3 months or more, the prices that the banks would take started to get a little squishy. And so we just started to pick off these properties that had long days on market and were pretty well beat up or had bigger issues going on.
Yeah.
And we just started doing one after another after another. And that was the beginning of it.
That's a really, do you see that kind of coming around at any point in time in the future? I know it's not as, like, the market today isn't what it was in 2008, 9, and 10, right? Like, that was just everything imploding on itself. Bad lenders, terrible programs, 120% financing, people, like dead people getting loans. Like, it was nuts. You know what I'm talking about. You're like, man, oh man.
I was in the trenches. I didn't fund a lot of those loans, but I saw them.
Yeah. So when do you think the REO market's going to come back? Do you think it's going to come back in the next year and a half or 2 or 3? Because banks have a very specific percentage of loans that they can carry on their books before the FDIC says, hey, we're going to fine you for having too many toxic assets, right? Do you think this is coming around sooner than later?
I think we're probably 3 years. With the most recent announcement of the Fed jumping back into buying the mortgage-backed securities, I think it buys us a little more time. We could get into a debate on whether or not artificially low interest rates have inflated the price of assets, real estate being one of them. I think when we get to the point where the plane will eventually crash into the mountain, it's just a matter of how bad. I think the at-risk segment of the market is going to be your first-time home buyer, FHA type loans. I think those are going to be the biggest candidates to eventually go foreclosure, go back to REO, mainly because, number one, they have virtually no equity in the property. They buy it, they put 3.5% down. They're upside down right away if they want to sell it with a realtor. And those people generally have the most limited amount of savings. They're usually at somewhere between 35 and 50% on their debt to income ratio. So they're very fragile, so to speak, if the economy was to tank. So I think that if we are going to have an influx of stuff that goes first to NOD, then to auction, and then eventually to REO, I think we're probably closer to 3 years out.
That's fair. You mentioned NOD, foreclosure, REO in that sequence. For our first-time investors, can you explain what NOD means, foreclosure, and then what REO means?
Yeah, it's just kind of the slow, tedious process from a homeowner not making their first mortgage payment to missing 4 payments and a notice of default is filed. So they're basically 120 days late. From then, that notice of default has an auction date. The property will go to auction if they don't get caught up on their payments. That auction property will have a bid number. If that bid number is too high, it won't get bid at auction for whatever reason, or maybe somebody misses it, or whoever's down there bidding misses it. It then goes back to bank owned, and at that point, it's assigned to a bank listing agent, and that listing agent comes up with some sort of valuation and puts it on the MLS in whatever market it's in.
Got it. And what's your strategy today? How are you making money in your market today?
So come 2010, 2011, I wasn't the only guy buying REOs. That became a pretty common strategy, and it was kind of like the low-hanging fruit. And so at that point, it was not as easy to get deals buying as an REO. Or if you did, they were thinner deals. The juice wasn't necessarily worth the squeeze as much as it was previously.
Yep.
So what we decided to do at that point is we said, you know what, we need to kind of take control of our own inventory. We cannot be reliant on market cycles or auctions or REO listing agent relationships. We need to figure out how that we can go directly to the source and have it be consistent no matter where we're at in the market cycle. And so what we did is we built out a marketing machine where we essentially go directly to homeowners. We built out an app that simplifies the process for us to identify, pull the information for these homeowners and then market to them. And so we basically have created a marketing machine that markets to specific properties in specific areas, and we do it continually. And all we're trying to do is start a conversation with these property owners. And at the point that they're willing to have a conversation with us, we can determine whether or not they're a viable candidate or potential seller that we could do business with. And so we just have a constant cycle of marketing going out, conversations coming in, and then we kind of sift and sort and find the stuff that works out for us in the middle.
So there's a lot there to unpack. We don't have the time today, unfortunately, to unpack it. Maybe we will at some point in time. What seems to be your secret sauce? Is it the mailing? Is it the yellow letters? Is it a postcard? Is it the conversation when they call in and say, hey, I'm a distressed homeowner. Can you help me out? Is it the capital that you have behind you? Is it the team? Is it the technology, the CRM, the follow-up sequence? Or is it all the above? And if it is all the above, and I'm throwing a lot of questions at you, but bear with me. And if it is all the above, where do I start?
I mean, it's a combination of all the above, but I'll give you the two most important.
Okay.
Number one is we're very creative with our direct mail marketing. So, I've been a student of direct response marketing for a long time. And so we send stuff that nobody else sends, from lumpy mail to crazy packaging to whatever it is. That's where it starts. Number two is the consistency. We send a lot of direct mail and we send it on an ongoing basis. We look at marketing as an ongoing action that we do every day in our business. But then number three is obviously the human to human interaction. That's a big part of this business. And so we try and be as human as we can be, as likable as we can be, and that has served us well. So that's probably the biggest thing. You got to be different, you got to be consistent, and you got to be likable and be good with the human to human side of this business.
I love this idea of lumpy mail. Like when I first heard this concept, I'm like, there's no way people haven't done this. And I'm like, why are more people not doing this? It's essentially it's like an envelope, and you throw candy in there, or you'll throw something that makes it like physically lumpy, because I'm more likely as a recipient of something like that to open the envelope and read through the letter while, sucking on the sucker or the lollipop or whatever. So I think it's a really cool tactic. When you're looking at the next 12 months of your investing activity, where are you focusing? Are you focusing on the single families? Are you focusing on rentals, flips? Are you looking at new construction? Are you looking at duplexes, tries, quads, long-term buy and holds? Are you looking at turnkey? Help me frame that up as we kind of close out the conversation here.
Based on where we're at in the real estate cycle, we're not acquiring rentals at this point. I feel like there'll be plenty of time to do. Having gone through multiple cycles now, I feel like buying and holding in my market here in Portland, Oregon, because I don't invest outside of that really.
Yeah.
There will be a better time 2 to 3 years from now to buy deeper discount stuff that we can hold. So we turn and burn everything. But with that said, we balance it. We have new construction that we do, and we look at that as our longer term projects. So land development, new construction is longer term. Our quicker turn, faster cash is our renovation project. So we buy single families or duplexes or triplexes, we renovate them, and we put them back to market. Single families, obviously, we're selling to an end owner. When we're talking duplexes, triplexes, we're generally buying ones that have been owned for a long time by mom and pops. They haven't been kept up. They have terrible tenants. And so we basically get rid of the tenants, we clean them up, we reposition the asset, we get them ready to be rented at, top of market. And then we sell them to a slightly lesser sophisticated investor or somebody who's just looking to get some sort of conventional loan against it, use it as some sort of a tax advantage, and also generate some passive income for themselves as well.
What's your advice for somebody that's a new investor? Is it to buy a single-family rental or a duplex or a triplex or a quad, maybe one a year, one of these properties a year. Just keep it nice and baseline, right? Like nice and easy, regardless of what's happening in the local market. Even if you're buying at a little bit of a discount and we're still at a high, then keep buying. And then even when the market starts to dip and go a little south, then keep buying. Just buy one a year at the very worst case scenario. Or do you recommend kind of what you're doing in your world of TTM development, where it's the acquisition, potential land development, potential reposition of assets, and then exit to a buyer that you deem fit?
I mean, what we do is a little more sophisticated. So if somebody's starting out, I think that you gotta crawl before you walk, right?
Yep,
and so for me personally, I think the path that I took of, number one, you have to have a place to live. So buying something that maybe you can add value, you can live in, you're going to pay rent or mortgage wherever you're at. So if the market goes up or down, you can ride out a market cycle as long as you're not getting over your skis on your monthly payment. You can rent out some bedrooms. You can do those types of things. I mean, my first house, my mortgage payment was like $1,200 a month. I had 3 bedrooms. I rented 2 of them out for $500 a piece. I had a $200 a month mortgage payment, basically. So it didn't matter what the market did with a situation like that. But that's a good way to start, because from there, you can kind of get your feet wet. You can start to figure out this whole real estate thing. You can start to learn valuations. You can start to learn areas. And then from there, you can segue, okay, do I want to do more single family? Do I want to get into multifamily? But at least you have some sort of foundation to work from. It's the people that jump in the deep end starting off.
Yeah.
Get into trouble,
Right, that's right. We've got to close out. Thank you so much for joining me. I appreciate it. You answered some good questions, some tough questions, and certainly appreciate the honesty and the transparency there. If I want to get in touch and just listen to the podcast, maybe get in touch with you directly, what's the best way to do that?
The best way to do that is just go on iTunes or Google Play, or just search on the internet. It's the Real Deals Podcast, and it's Deals with a Z. Or you can look me up on Facebook or Instagram. It's just Tucker Merrihew. We post a lot of our projects, a lot of the stuff that we have going on. You can friend me, follow me, and check out our content.
You know what I loved about that is there was no go to www.blah.com, right? It was follow me on Instagram, follow me on Facebook, and listen to my podcast. I love where the world is going with this media stuff. I think it's fantastic. Tucker, thanks so much for joining me and giving me a little bit of your time. I appreciate it.
Thanks for having me.
You got it. This segment is brought to you by Narada Real Estate Investments. And when you go check them out at turnkeyrealestateinvestments.com, go say hi to my good friend Marco Santorelli. Narada Real Estate Investments is your premier source for cash flow investment property. Check him out again at www.turnkeyrealestateinvestments.com. All right, insurance tips. Why is insurance for your home so important? Well, for a variety of reasons outside of the obvious. But when you are renting your home to others, you want to make sure that you have the right renter's insurance that your renter takes out, and of course the right type of insurance for your home. Does it make sense to pay a little bit of an extra premium so that you know you're fully covered? Absolutely. I did some research about the different types of insurance and different policies, etc. And one of the things that I found is that it's really important to remember that insurance policies don't cover every type of loss. So you want to make sure that you understand what type of losses your insurance carrier and your policy will cover. Therefore, it is really key for you to familiarize yourself with these types of coverages. So let's talk about wear and tear for a second. All right, wear and tear for me is something that I thought initially would just be covered. But guess what? It is not covered. If your tenant leaves you with damaged window blinds, for example, you got smudges on walls, stains on the carpet, broken lots, these are considered not covered by most insurance companies and policies. Therefore, guess what you do instead? Collect a security deposit. And sometimes, depending on who you're working with and your property management company, etc., you may want to say, I want to collect first month's rent, last month's rent, and security. Just kind of depends. So, insurance tip, get the right insurance, shop around, ask the right questions, and go from there. My wealth building tip is, for me, a good one. I'm a huge fan of self-directed Roth IRAs, okay? A self-directed Roth IRA gives you supreme power. Essentially, what a Roth IRA is, it's an investment vehicle. It's an individual retirement account. It's an investment vehicle where you put money in after having paid taxes on this money. Now, what you can do is after accumulating a couple $1,000s in a Roth IRA, you can transition that and convert that to a self-directed Roth IRA. And then guess what? You can really win here. If you participate in wholesaling deals, partially funding deals, lending deals, all of the money, all of the returns, all of the interest, all the JVs, as long as you follow the rules, get put right back into your self-directed Roth IRA account. And there are two words that make me smile from ear to ear about a self-directed Roth IRA. You know what it is? Tax-free. That's right. You have control over your finances, you have control over where your money goes, and when it comes back to you, it's tax-free. That's the show. Have any questions, get in touch. Go ahead and go to thinkrealty.com. We have a magazine as well. It's called Think Realty Magazine. You can pick it up at your local Barnes & Noble. This podcast is brought to you by Renters Warehouse, one of the largest and fastest growing and highest reviewed property management companies in America. Check them out. Go to renterswarehouse.com. Think Realty Nation, that's a wrap. Have any questions again? Head on over to thinkrealty.com. Until next time, happy investing.